Performance in February was flat compared to the MSCI All Country World, which rose by about 2% for the month. Oil and gas, airlines, and banks did particularly well in February due to positive news on the vaccine front, increasing commodity prices, and a steepening yield curve. All of these industries are underrepresented in our portfolio, which led to a performance drag overall. Year to date, we are about on par with the benchmark, and over a one-year period, we are outperforming by 15%. The big story in financial markets has been a rise in yields based on expectations that the economy is healing faster than expected thanks to fiscal spending and vaccine rollouts. Long-term yields, especially the real yield component, have been increasing strongly. For instance, 10-year real yields in the US rose swiftly by nearly 50 basis points during the second half of February, and markets started to aggressively pull forward rate hikes. And this led to a strong sell-off in growth-oriented stocks due to an increasing discount rate. However, with the current levels of debt around the world, which is likely to go even higher, it's more likely that real yields will have to stay low for a very long period of time. Any return to something close to long-term averages would have drastic consequences for debt sustainability. Also, central banks have signaled that they are willing to tolerate higher inflation, and inflation expectations are still well below target in most places. And meanwhile, the yield spike has somewhat abated. The bottom line is that central banks are unlikely to hike rates anytime soon. Higher real yields are generally a good sign that the economy is improving, while inflation expectations are still in check, with plenty of slack in the economy. And this should give our portfolio plenty of runway to perform going forward. In general, we think stocks are reasonably valued. They're not cheap, but we also wouldn't describe them as particularly expensive. We prefer to be invested in companies that have strong free cash flow generation and solid growth profiles. More importantly, the rise in stock prices has been supported by strong revenue and earnings growth in our portfolio, and the recent dip provides an opportune entry point.